What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is April 25th of 2019. Well, folks, I hope you all are having a fantastic day wherever you are. And today I want to spend some time to briefly and easily explain why economic recessions not only happen, but also to understand why we keep making the same mistakes that are going to lead to the same results. Now, if you guys enjoyed this video, the only thing I ask that you do is please share it with family and friends. I think it's very imperative that we understand how our economy works and also understand where we're going over the next few years and why what could be coming could be much worse than what we've seen beforehand. All right, so let's go ahead and talk about the first thing, and that is equity markets, so stocks in this case. We can obviously see over the last few years, we've got the time frame down here. Over the last decade, we've been on an absolute rally in most stocks. We're taking a look at an index known as the U.S. Wall Street 30. It's a collection of 30 major companies that are publicly traded. And you can see here that, back here in 2007 to 2009, we had the decline from the recession, and since then, a rise up to the highs here that we've been setting all the way since back here in February. But with a tripling top of heads here, as we can see, there's a top here, a top here, and a top here. We're starting to see reminiscence of what we saw back here in 2007 and starting to step into 2008. Now, I don't want to go ahead and just simply use technical price action. I think a lot of people can throw a ton of different indicators at you. And we've talked about a lot of them before here on the channel. We sometimes talk about charting patterns being very similar to valuations that we've seen or price movements that we've seen back in previous cycles. But it would be kind of naive not only to just focus in on one traditional cycle here that we've seen, but along with that, to toss around some of the generic indicators that we've already seen. Unemployment being extremely low tends to be a recession indicator. Most people already look at that. What else is there? I think there's a dozen different indicators I could toss at you. But I really actually want to get more to the core fundamental principles. So we're going to do that right now without me rambling too much. So in the next few days here, coming up here on April 3rd or May 1st, it's more likely going to be May 1st from at least the estimates that I've seen, we are going to have an FOMC meeting. This is one of the monthly meetings that tends to come up from the Federal Reserve that goes about talking about changes in monetary policy, their current analysis on the state of the economy. Very important meeting in regards to not just the broader economy, but specifically equities. Equities or the stock market move very dramatically off of these announcements. A lot of different financial instruments do, gold and silver as well. And at these meetings, they tend to do one of two things. They either change interest rates or they leave them be. And then they also might decide to adjust their balance sheet, which is basically the assets that the central bank owns. So over the last few years, you've probably heard about a term known as quantitative easing. It's a very fancy financial term where basically banks print new money. They have the right to do this, or the central bank of the United States, the Federal Reserve, has the right to print money and purchase financial assets. And they did this to help stimulate the economy and to help provide relief by buying up U.S. treasuries, by buying up toxic assets like the mortgage-backed securities that caused the 2008 recession, etc. And in some economies, like in Japan, they actually go as far as to buying up their own stocks. So they actually would buy up stocks or ETFs, which are baskets of stocks, on the open market. I know I'm throwing a lot of language at you guys for those of you who might be kind of new to this, but some of you out there might be very well in the know of what these terms are. Now, because this meeting is coming up, we have to consider the fact that in the broader market of things right now, we're actually expecting the Federal Reserve will not change interest rates. Really, this has been the only thing that the Federal Reserve has really, changed over the last few years. Its central bank balance sheet has been on autopilot, basically meaning that they've been reducing their holdings on the balance sheet since back in around 2016, 2017, but at a very, very slow pace. But even though a lot of people are expecting that the Fed will keep rates at around a range of 2.25 or to 2.5, in this case, 2.5% interest or 250 basis points, I have a feeling that we actually will have to see a decline in interest rates. And in fact, that the Federal Reserve might consider, or at least mention that it's considering, the idea of adding on to its balance sheet, meaning that it could be picking up treasuries or other types of assets, but more specifically, that it's going to do what Japan's economy has done, and that is picking up financial assets off of U.S. equities, meaning stocks like Apple, companies that we know day in and day out. So why would they have to stoop to this level? Why would they actually have to go that far? Well, it has to do with the fact that at this point, we have raised rates, and the Fed has an incentive in order to protect the value of the US dollar to keep rates high, right? But they can't raise it too high, because if they raise it too high too quick, it starts to put a damper on the cost of being able to access new money or credit that stimulates assets, right? There's a lot of people who have borrowed money or are borrowing money on leverage to pick up financial assets, to basically invest and to make a return in the market. And when you stop to, you stop providing that easy that easy supply of capital, then you start to have less buy-side demand for U.S. stocks, and that can lead to economic recessions. So the Fed's been on this balancing act, and in fact, over the last few months has actually decided ever since January to pretty much keep the effective Fed funds rate, the rate in which banks, have to charge one another to borrow capital, at a relatively flat level, right? So this is kind of the base important interest rate that everyone should know about, but they've been able to keep it flat here. Now, I want to actually talk about it, really expanding this outside of the broader term of the time range that people look at. And we're going to get to a key fundamental lesson here. And that is understanding where we've been beforehand, right? So this is a very, very long-term view, all the way back to 1830. It's very difficult to find. If you look really hard enough, you can find this. Basically, of short-term interest rates back all the way to 1831, if you can believe it. And we can actually get a really good view historically about where we've been and where we're going and how things are going to be different this time, okay? So I'll try to keep on pace and compile everything. So we've talked about, again, the Federal Reserve raising interest rates. This chart doesn't show us the most recent price data. But basically what happened is we actually had a very similar period here to 1930 all the way to 1950. Almost a 20-year period. I would say, actually, if you deduce a little bit of the decline here and a little bit of the increase in 1950, really about a 10 to 12-year period where interest rates were around 0 to 1%. Now, that is extremely low, okay? This is really the only time that we have in regards to our economic data that was similar to what we saw in 2009 to 2015 and 16, where interest rates were practically 0 to 1%. Most of the time it was 0% at the base Fed funds rate. So this is an important, significant time, to possibly look back and see, well, what happened at this time period? Well, it turns out that in the 1950s to the 1980s, we actually had an explosion of interest rates. And not only that, we had a massive economic expansion. We saw the economy continue to grow, after the post-war era in the 1950s. And with interest rates being able to rise, you actually built a really strong saver economy where people were actually able to just put money in a savings account and voila, they were actually able to set up for retirement and raise a family. But there is something that's very different about this time range. We have to look at the different underlying economy and, not only just where the economy was and where it was going, but also something that's very key, and that's debt. And we'll take a look at that in just a moment. I do want to clarify something real quick for those of you who are a little more, monetary bugs like myself. You might notice that the date here where it says the Federal Reserve was created was in 1920 something, which is technically not true if you're considering the fact that the Fed was created in 1913 through the Federal Reserve Act. But I would say to bear in mind what this is basically saying is that the Federal Reserve, in this case, as an organization, has gone through multiple changes over the years. In fact, it states here that the 1933 Banking Act was the first thing that amended the Federal Reserve to create the FOMC, or the Federal Open Market Committee, which is what we were just discussing a little bit earlier. So the Fed's gone through some changes. And in fact, you can sign a bill overnight, but it's not going to build the organization right away, right? So anyways, just want to make that clear for some clarification for those of you out there who might notice the date. So let's go ahead and talk about why things are different here. Why is it different this time around? Well, we've got the Cato Institute who put out a really nice article here in 2013. We're having to work with some data points that are quite scattered. But if we take a look here, back at that time period that we talked about, we had a very interesting scenario where basically we're actually at very similar levels. In fact, we're a little bit lower, at lower levels of debt to GDP than we were actually during the war era in the United States in World War II. And we had a major spike here as wartime spending started to come into play. And federal debt started to consume GDP over 100%, in fact, towards around 110, 115% in a very short period of time. But interestingly enough, once the war ended, that spending was reduced. We stopped spending as much as we did federally on the war. Not to mention as well, we had an economic boom afterwards. In fact, there's massive manufacturing, there was globalization, industrialization, all types of different growth factors that came into play, and a real formulation of the middle class, which was really interesting to see historically. Nothing had ever been, that successful. On that kind of scale as well. But as we take a look here, we're expected to not only increase our debt over the next few years back to those levels, but this isn't a wartime economy, and this isn't factoring for wartime spending. This is factoring for entitlement programs for our healthcare industry. This is factoring in for pretty standard military spending in the United States, not for a wartime era. We're actually in quite peaceful terms right now in the sense of wartime activity compared to where we were back in World War II. All these standard expenditures that we have are almost seen as a given. In fact, most of it isn't discretionary spending in the federal government. And this isn't even talking about debt in the public sector outside of federal debt, which is about 5 to 6 times larger. Actually, I take that back. Sorry, it's about 3 to 4 times larger. That's all personal credit, home mortgages, auto loans, student loans, etc. So the thing I want to bring up here that's important to realize is that we were able to reduce federal spending after the war, not to mention we had a post-war era economic boom. We don't have either of those this time around. And if we take a look at federal spending here, it makes it very clear. Instead of having a very quick uptrend line in federal spending and a decline, which allowed us to basically raise interest rates without the interest on top of that debt being too bearing, we have been having consecutive years of increasing federal spending as a percentage of GDP, which means that we're taking on more of a deficit maybe not a larger deficit every year, but more and more debt piling up every year. And on top of that, when we raise interest rates, the burden on that debt is going to grow larger and larger and larger. The reason for that is because as debt is growing larger over time, as you increase interest rates, well, obviously you're going to owe a higher interest rate on top of more debt, right? So taking that into account, this is not a good combination. And we don't have the roaring economy to pay down that interest. And we also don't have that easy deduction, right? We're not going to have any way to cut federal spending like this when we start to get to federal spending as a percentage of GDP at similar levels. We're already at pretty high levels here, very similar to the range we saw here in 1920, right? So this is a very scary thing. And I want to spend some time to discuss something that's been getting a lot of buzz as of recent. You'll probably hear this if you're an economic bug like myself, and you've been getting into these kind of new discussions. If you always like to be on the cutting edge of what's going on, a lot of people have been talking about something known as modern monetary theory. And I think actually here in Wikipedia, they summarize it quite nicely. MMT advocates argue that the government should use fiscal policy to achieve full employment, creating new money to fund government purchases. The primary risk once the economy has reached full employment is inflation, which can be addressed by raising taxes and issuing bonds to remove excess money from the system. Modern monetary theory is controversial with active debate. Okay, so you get the point here. I just wanted to read that off to make it very clear. So MMT, interestingly enough, is kind of proposed as a theory. It's this idea that we can go about, borrowing ourselves into oblivion, really, because unlike an individual who can go bankrupt, a government can't go bankrupt. It generally prints its own money. Well, we know actually the Federal Reserve, which is more seen as if you actually really know, it's more of a private bank in this case, or a private institution that's mostly ran by most commercial banks in the world. We know either way, though, that there is a way that basically the government can finance any program it likes. If it wants to expand into wartime efforts, it can. If it wants to expand in healthcare efforts, it can. It can simply just print some dollars into thin air and dilute the currency supply or inflate the currency. Now, on the short term, modern monetary theorists actually talk about this as being a good thing because basically we can pay for any government program we want. For example, entitlement programs, no worries, even though we don't have the tax dollars for it, let's just print some money into creation and we're going to give it out to those who need it for healthcare expenditures. And the same can be said for any program, as we mentioned, military spending, education, anything of that sort. We could print enough money for everyone to go to college for free, right? Well, the one thing that they mentioned here is that the primary risk is inflation. And this really speaks to something that we have to talk about. As we start to get larger and larger in the sense of debt, and we don't reduce our debts, debt piles up, and the interest income on top of that, and the obligation that interest holds without us paying it compounds over time. It's become a bigger and bigger factor of our economy. And if you look over the last decade, interestingly enough, if you actually look at like the websites like the US Debt Clock, you'll see that over the past few years, where it used to be military spending and healthcare expenditures that were really the only things we spent money on, interest income becomes a bigger and bigger portion of the deficit. And we're actually ending up having to squeeze out of normal expenditures that we would be putting our tax dollars towards. But we can't. We can't put that money towards those things because we have to go back to paying the larger interest obligation. And this is what modern monetary theorists don't talk about, because the only way you're going to pay that down in the short term is by printing more and more money. And you inevitably will face that inflation because people will always make the excuse, well, look, we have to pay for this healthcare expenditure. We have to pay for this entitlement program. If it means having to inflate the currency supply past 2%, that's the Fed's normal target, towards 8 or 10%, it's for the greater good. And think about the children. We have to do this program, which is going to bump us up to 12 or 15%. And we need to protect ourselves from foreign adversaries, 15, 20%. And then what you start getting is towards a currency collapse, hyperinflation. Now, if you even don't want to believe in that far viewpoint in the future, which definitely is playing off of the idea that we're going to get carried away with modern monetary theory. We don't need to look that far to know that it's not good for the average layman or everyday person, right? We can go ahead and take a look here at an article from Mises here, which is an economics website. And we can go down and take a look at this one graph here. This will give us all the summary we need. It's very clear and visual. When we had a gold standard in the United States, I'm not even, for example, a major gold bug in this case, and I don't have gold everywhere in my house. But I will tell you all, something to take away is sound monetary policy and what it can do to uplift economies, and when it's taken away, what it can do to decay economies. We can see here over time, as the gold standard was relevant, we had one of the largest expansions in economic history. We also had a standard, well-developed middle class going into the 60s and 70s. We set the world standard in the United States. It used to be something we could be proud of financially. And when under the 70s, under the Nixon administration, we had the revoking of the gold standard, where basically you didn't need to back a $20 bill by an ounce of gold, or I might be misinterpreting the amount of gold, but a gram or an ounce of gold of some sort behind that $20. When you started to remove that standard for the US dollar, you basically allow for any amounts to be printed. And in fact, in a digital world that we live in, the vast majority of money is now just numbers and systems. It's around 97 to 98% just simply digital numbers typed into bank ledgers. So what happens when you do that? Well, you get wealth inequality. The same thing that modern monetary theorists are preaching against, and the same thing that I think a lot of us at the end of the day, I don't really care if someone's wealthier than me, and I don't think that they owe me anything, but we can see that this is going to lead to a diminishment of the average everyday middle class in the United States. We've seen it in real time. And as that expansion of wealth in a very select few has continued to grow, we have to ask ourselves why it's happened. We shouldn't be reactionary. A lot of people out there are very reactionary when they come to this topic. They say, we need to tax the rich. We need to do this or that. And, simple patchwork on top of what's happening without actually understanding why it's happening. And it has to do simply with that clear, utter fact in this case, that when you print excessive currency, it is going to benefit a select few. And the reason for that, If we take a look here at the distribution of family wealth here by percentile, you just see the parabolic rise here to the top 1% of families owning on an average 10.4 million in the United States. Why is that? The reason for it is because it tends to be that the top 1 to 5% in the United States are the most exposed to assets. The top 1% in the United States owns roughly around anywhere from 35 to 40% of all assets in the economy. The bottom 50% of Americans own 0.5%. So when new money created into the system, new money printed by the Fed, is going in most cases, to stimulating economic assets. When companies are not making investments in the real economy by building factories, by employing new individuals, and in fact is really just taking profits made and putting it into buying up their own stock, you start to create artificial bubbles of wealth for a very select few people who know how to play the game, who aren't spending their money, who aren't taking out credit or debt, who aren't, in this bottom percentile where actually you start to have a debt burden as your net worth, right? You actually don't own any wealth. You actually owe a lot of wealth. This is what causes this S-curve of wealth. This system is inefficient. It doesn't work for the average everyday person. And that's why we need to have a sound monetary policy. It doesn't mean that we per se need, say, the gold standard. It means that we need a currency itself that doesn't inflate, that encourages saving, and encourages people to thereby, think in the long term rather than the short term. This is how economic cycles work, folks. And I hope today I was able to explain that to you. I know it was a little bit lengthy, probably a little bit, off the end one way or the other, and probably, bouncing around looking at a lot of different facts. But this is probably the best way to summarize it within data. And I hope you guys enjoyed it. So if you guys liked the video, please leave a comment down below, share it with family and friends, get the word out. And if you'd like to see more of this on the channel, I'd be happy to talk further on any of these topics. Leave a comment down below if you have any questions. Anyways, that's going to be it for the video, everyone. Thank you all so much for watching, and I'll see you all in the next one. Stay tuned.